Like,
I'm going, we're going.
okay.
This is exciting. We have not done this master class in so long. I'm actually very, very excited to get this going.
It's fun to do.
Yes, so many people are going to benefit. Okay, so it is starting to connect.
I got a notification that we are live on YouTube.
We are live on YouTube. Okay, we are so excited to do this masterclass. We're actually live on Zoom. So I literally have a live audience here on Zoom. We're going to start letting them into the waiting room. I have a very special guest, an expert on becoming mortgage free. This guy is absolutely amazing, and I absolutely love this. I think you guys are really going to enjoy this content today. This is something that's really going to help a lot of people. And I think the issue is so many of us don't even know this exists. So I'm always excited when I can bring information to us that I know I've paid so much money to receive and it's really hidden. So this is always fun. So welcome, welcome. Michael Lush, are you ready?
I'm ready. I do see where James said that there's no sound, but I hear you just fine.
Okay. Let's see. I think the issue is so many of us don't even know this exists. So I'm always excited. Okay, so do they not hear the sound? Do I have to do like this? Can you guys hear me now? So much money to receive, and it's really.
I can, but I'm also hearing the playback.
Welcome. Yeah, they can hear you when I mute the playback, can they hear me still? I think that's kind of the issue. So if can they hear me now? Can you guys hear me? You can hear me. Okay.
Yep.
On the YouTube world, can they hear? In the YouTube world, can they hear? So James says he can hear.
Yes, we hear you.
Okay, awesome.
That was a sweet voice.
Yes.
Yes, I can hear you.
Okay, awesome, awesome. All right, we're gonna go ahead and get in and get started. Like I said, this is always amazing. So Michael, oops, now Michael's muted. Okay, here we go. All right, there you go. Now you push the button. There we go.
Welcome to technology.
Yes, exactly. All right, I'm going to let you actually go ahead and get started because I know that you are the expert. You have so much information to share. I'm actually so excited to learn and hear some of these things because you always give me new information that I don't even know. So this is always fun for me to actually even listen and hear some of this information because this is going to be an amazing masterclass.
Yeah, I'd love to start. Well, let me give some folks some background about myself so that you know that, I'm certified and I'm an expert in the industry and have the wisdom to speak on this matter. I started in the mortgage business. It was actually my first gig right out of college. And yeah, it was funny. It was something I didn't want. Obviously, I thought I was going to be a professional basketball player, but I'm only 6'3", so that wasn't going to happen. So I had a buddy that graduated ahead of me. And he went to work for a large firm, ninth largest lender in the country. And he came over to my house one day. I say house. I was a poor college kid or just graduated from college. So it was a duplex I was living in. And he said, man, I think you'd be good at what I do. And I think I can get you an interview. Are you interested? I said, absolutely not. I don't know anything about mortgages and no, I don't want anything to do with it. And then it was a second visit. He came by with like this pamphlet, the sheet of all the commissions that were being made. And he showed it to me. He said, this is what people are making. I said, all right, I'll figure it out. Get me an interview. So he got me an interview. Long story short, got the job, made some outlandish claims. I didn't know what I was talking about. I just said, you know what? Let me figure out a way to nail the interview. And once I get the job, I'll try to figure it out from there. But really took to it once I got the job. And I think one of the reasons I did so well in it, I rose through the ranks quickly, from loan officer to senior executive. My last station with a bank was a senior vice president of a federal bank prior to launching this company 10 years ago. It started out as what's called evict the banks. And the more I started doing business with banks, they didn't like that too much. Like, you need to change your domain in your email. So we quickly changed it to replace your mortgage. And a couple of years ago, about 3 or 4 years ago, we leveled up and we call it Replace University. But what you're going to hear about tonight is exclusively Replace Your Mortgage. So we've got a lot of financial services and education in our platform, but I want to only talk about Replace Your Mortgage tonight. So back to my story, rose through the ranks, and it was actually on my birthday in December of 2007. So if you fast forward a year, everybody knows what happened in 2008. You had the real estate meltdown. Well, we saw it in advance. In fact, my branch, we had about 100 to 125 loan officers in Charlotte, North Carolina. In July of 2007, we were doing 600 units a month. And then by September, 2 months later, we were doing about 50. So it cratered. So the company filed bankruptcy, laid everyone off. You fast forward about 12 to 14 months, they called me back and said, hey, we're going to open back up. We got money from a hedge fund, and we'd like to make you director of operations. There's no problem. I promise you where I'm going with this, you'll understand, because the story, it's kind of cool how it went from there to where it is now. So they got this money from a hedge fund, made me director of operations, and I moved back to Nashville at the time. So I was in Charlotte, North Carolina. Almost my whole family lives in the Nashville area. And I said, I'm going to take this opportunity to move to Nashville. So I did. So they heard that I was in Nashville, called me up and said, hey, we're getting the band back together again. We'd like to make you director of operations. We got money from this hedge fund. I said, cool, let's do it. You know, I'm going broke here. And when I say broke, I think it's also important to note, you know, right out of college, I was thrust into multiple six figures. And then, you know, met my wife there as well. She was making multiple six figures. I rose through the ranks. Collectively, we're making $500,000 or $600,000 a year at like 22, 23, 24 years old. And it was 2008 really needed to happen to me, to be honest with you. I needed to be humbled because I didn't know what it was like to budget. I didn't understand finances. I just knew, all right, whatever I buy, I'll just go make more money, right? That forced me to not only be humble, but it also forced me to kind of dig into this stuff. And I really wasn't looking for it, to be honest with you. I got back on my budget. I went broker than broke. The house in Charlotte was foreclosed on. My Cadillac was repossessed. My Denali was repossessed. My four-wheeler, my motorcycle, all that stuff gone. I actually had to move back into a family home on the farm that happened to be vacant. And yeah, very, very humbling times. We even had an episode where we went to Walmart, where we would grocery shop at the small town that we were in, and had some embarrassing moments where we get to the checkout and there's too much in the cart than what we had in our bank account. So the next visits, I'm sitting there doing the math, making sure that everything goes in there plus tax. We've got enough in our account to cover it because I didn't want to be embarrassed again. So fast forward back again. I bounce around. I've got ADHD and I've refused to medicate. So I'll bounce around a little bit. Noelle, if I ever get too fast or too high level, just stop me and say, hey, can you revisit that again? And let's explain that a little bit further. I'll be happy to do so.
No worries.
So again, get back the band back together again. We got the money from a hedge fund. The hedge fund manager lived in Connecticut, but he would fly to Nashville from time to time, not to see me, but his parents lived in Nashville. So he would just double up on his visits. And as he would come in, he would make it a point to stop by my office to check up on his money. I was responsible for spending his money. He wanted to make sure his money was being spent wisely and that he was going to get a return on it. But he would also spend some time to mentor me. And it's important to note that at the time, he was worth about $600 million. Now he's a billionaire. Still the same position, hedge fund, doing really well, obviously. So I'm like, yeah, I need to figure out what he's doing. Birds of a feather flock together. So let me try to figure out an angle to really get in his sphere of influence. And so I pitched him, said, listen, introduce me to your friends and I can do their mortgages. And if your friends are doing mortgages, they're big mortgages. And as you know, big mortgages have big paychecks, big commissions, and you get your money back faster. He said, Michael, that's all well and good. He said, but my friends don't do mortgages. And I was like, that's kind of what I figured. You just pay cash for everything. He said, absolutely not. He said, think about it. Hedge funds are the kings of leveraging other people's money. So we still leverage other people's money. Now, it may be institutional money, it may be private money and things of that nature. He said, but we still leverage money. We just don't do mortgages. And that's when he said this phrase. And if you have to write this down, write it down, but I'll say it really slow. He said, mortgages are financial crack to middle America. The poor can't afford them and the rich don't use them. I understood the poor part. It's like I wasn't getting anybody qualified that was poor because, you know, after Dodd-Frank, you had to have what was called ability to repay, and you had to prove your income in order to qualify for mortgages. So I knew that part. I kind of ignored that. I said the rich don't use them, but you still leverage money. So what is it? He said, mortgages is old French for death pledge. It's an installment loan. It's an amortization schedule. So what we use is lines of credit, specifically like a home equity line of credit. Everything I had been taught in the industry was that a HELOC was bad, that it was a credit card on your home. And credit cards are bad, right? Truth be told, credit cards are not bad. It's how you use credit cards that make them bad. Credit cards can actually be a very good tool if you know how to use them appropriately. So same thing with HELOCs. So that's what I'm going to explain tonight. And that's how I came to know the strategy. I wish I could say this was something that I did a deep dive on. And I'm like, hey, I got this epiphany and I'm going to create something, innovate something. I'm just going to be transparent with you. I got this from a hedge fund manager. And if it's good enough for them, then it's good enough for us. You don't have to be elite. You don't have to have massive wealth. Banks have these tools for everyday Americans like us to execute on this strategy. So it's not just a debt tool, but what I'm also going to go over tonight is the actual execution of it and a cash flow strategy to make this make sense. Now, having said that, I'm going to preface this. This isn't something that's for everyone, right? And what I mean by that is one of the most important things that you have to master is your budget. You cannot be spending more money than you make. So in order for this to work for you, you have to make more money than you spend. Your budget has to be in line, not necessarily mastered, right? But you need to understand that your burn rate cannot be 100% of your cash flow coming in. There has to be a margin there. And quite frankly, the larger that margin is between income and expenses, the more this can benefit you, even above paying extra on a mortgage. And I'll get into that as well. All right, so let me screen share. I got a slideshow for you guys. I promise I know people don't like slideshows, so I'm going to try to make this as entertaining, as fun as possible. And again,
information. Like I said, I know that this is good. So I like a slideshow too because it keeps you on track.
Yeah, I'm trying to see my slide. As a matter of fact, I may have to minimize my screen on that I see you guys on. So let's try this. There we go. All right, let me screen share. All right, you picking me up there? You see Replace Your Mortgage Masterclass?
Here we go.
All right, perfect. All right, so this is what I want to go through tonight, and I'm going to go as slow as I can because I have a huge habit of going really, really fast. So if you guys feel like I'm going too fast, and here's the other thing, we're going to spend some time at the end of this answering some questions that you guys may have. So I'm going to go slow. And I want to warn you too, or not warn you, I want to preface this. It's not a hard concept once you really get into this and dive into this. The execution, a little bit complicated, but I'm going to try to make this as simple as possible. And honestly, it's one of the best compliments I get is like, Michael, you make this sound so simple. And I'll be honest with you, it's because I think so simply. So some people think I should be a teacher because I'll take complicated things and I'll put them in redneck terms so that I can understand it. Hopefully I can do that for you guys too. All right. So what you're about to watch is the Replace Your Mortgage Masterclass. This is one of my favorite quotes. This is from Henry Ford. It is well enough that people of our nation do not understand our banking and monetary system, for if they did, I believe there would be a revolution before tomorrow morning. So I'm going to spend the first half of this explaining what the problem is in detail. Then I'm also going to provide you with a solution on the back half. So even giants of industry like Henry Ford understood that the banking system is a major pitfall for middle America. So let me also explain who we are. So Replace University was created to fill the void of real world applicable education is not taught in traditional schooling. And let me rewind. I told you I was a college graduate. I actually went to school for corporate finance. None of what I'm teaching tonight was ever shared with me in college. And in fact, that one course, corporate finance, I was talking to my teammate about a month ago. I was like, I'd love to find that guy because he would be amazed at what I'm doing today because I was one of his worst students. So we are teaching the reality and pitfalls of traditional financing. We are comprised of mortgage and real estate experts with a combined experience of 50 plus years. So as you can see, these are all of our different verticals. But again, we're only going to focus on replace your mortgage tonight. And on just replace your mortgage, we're well over 8,000 clients at this point, again, founded in 2014, and we serve every state in this great nation. So what do? So we're going to demonstrate the effectiveness and the efficiency of simple interest calculations like lines of credit. An example of a line of credit could be a credit card, a HELOC. HELOC is short for home equity line of credit. BLOC is short for business lines of credit. Believe it or not, folks who don't currently own a business can get access to business lines of credit. Now, what I said was you don't currently own a business. It takes about $30 to file an LLC with your state. Some states a little bit more, some a little bit less. But there are ways to get you funding on business lines of credit inside of 5 weeks. And we're not talking $1,500. We've got tons of clients that we've helped with this, that on the low end's 58,000, on the high end 310,000. So believe it or not, you can get business lines of credit if you don't currently have a business, et cetera. So commercial lines of credit as well. So you're going to have questions and concerns, and I'm going to address all of them in this event. So some of your misconceptions or concerns would be high rates versus low rates. Rates are higher right now than what we were experiencing in 2020, 2021. Not so much in the HELOC world if you know where to look, and I'm going to show you that as well. Also, wouldn't it just make sense if I just pay extra on my mortgage? So I'm going to address that as well. There's a difference between first lien position home equity line of credit and second lien position home equity line of credit. We help people with both. A lot of people don't realize, there's an example of a first lien position home equity line of credit. A first lien position home equity line of credit is very simple. You take your existing mortgage and you refinance it into another tool. And that other tool is a home equity line of credit. Most folks did not realize that it even existed. And that was what I saw or tried to do in 2012. And it took me about 10 different banks and on average 4 people at each bank to get to the right person that actually understood what I'm explaining to you guys tonight, that a first lien position home equity line of credit is possible. Did I explain what a first lien position is thoroughly enough there, Noelle?
Absolutely. Absolutely. First lien,
okay.
Mortgage position, second lien, I think, yes, absolutely.
It's just refinancing. And you don't have to have massive amounts of equity. In fact, you could only have 10% equity in your home. Say you owe 90% of the value of your home. You can actually refinance that entire 90% of that mortgage, all of it onto a home equity line of credit, which once I go through this tonight, you'll understand why it's a far more efficient tool to evaporate the debt. You can actually purchase as well. People didn't realize that too. So let's say, you're a real estate investor and you want to buy some rental properties. You could actually put 20% down, and the actual financing debt tool at closing is a home equity line of credit. It is not a mortgage. On a primary residence, we like people to stay around 90%. Yes, there are some banks that go to 95, even 100%. Heck, I know of one in Utah that does 125. Not really good terms. So don't get excited when you hear that. Their terms are terrible, but believe it or not, you can get really high LTVs on that. All right, this is not a scam either. This has been practiced in other countries for a very long time. So I could not make money teaching this in Australia. 83% of Australians, this is what they learn in high school. It's also the reason why Australians have the highest rate of second home ownership, because the average Australian can have 2 homes paid off on an average of 14 years. What do you think the average American gets their home paid off?
Never wary. 30, of course.
I love that term. I'm going to start using it. I'm going to steal that. Yes,
30.
never. So this is a bank scam, and I'm going to help you understand the problem that is the bank scam. So you've got to understand the banking system. The banks, all right, so there's key components to when it comes to the banking system. For example, if a bank pays you 1% on deposits, which they're not, the average is like 0.24, but I just want to keep numbers very general and easy to understand. So if a bank pays you 1% interest on deposits, they may charge you 6%, 7, 8% on loans, right? However, the average savings account rate in the US is currently lingering around 0.24% APY. And that's according to Go Banking Rate data, right? Now, they also charge customer fees for services to do with managing the account and earn money from bank charges levied on like overdrafts, which exceed agreed limits. So essentially what you're doing is you're giving your money to the bank and they charge you fees to keep it and only give you 0.24% and then lend it back to you in the form of loans at a much higher rate. So again, that's called margin or term. So think about it from this perspective. Let me give you a visual. You walk into the front door of a bank. You turn to the right, you see a sign, you got a teller, and the teller says, hey, come over here. We're offering 1% on checking accounts. Again, not the case. On average, it's 0.24. But they're like, yeah, come over here. Open up a checking and savings account, CD money market. I'm like, no problem. Sounds like a good deal. Here's my money. And they're like, oh, by the way, do you need a mortgage? I sure do. Well, right across the hallway over there is the loan officer. Can you go see him? Cool, no problem. Walk over there. Loan officer says, congratulations. We've got 6.99% that we can offer you. Like, especially in today's market, you're like, wow, that's a good deal. Secretly, the teller walked your money. This isn't really what's happening, but it's virtually what's happening is the teller's walking around behind you and giving it to the loan officer just so the loan officer can give it back to you. That's essentially what banks are doing. I'm taking something very complicated and oversimplifying it, but that's essentially what banks are doing. It's called margin or term. Now, you're getting that 0.24%. However, we have inflation. And as we all know, over the last 2 years, inflation has been skyrocketing as illustrated by this graph. So inflation's really high. However, historically, the inflation rate is 3.3%. So now let's think about your bank account in terms of what you're getting from an interest rate perspective with your deposits, your checking, your savings, your CDs, your money markets, and then factor in inflation. So you're reading it right. Your bank account is actually a liability. I'm going to say something even more astonishing. The more you have in there, the bigger liability you actually have. Here's why. You deposit your money into the bank account at 0.24%. The average historical inflation, again, is 3.3%. So therefore, you have a negative rate of return of 1,375%. How many folks would sign up for an investment that is guaranteed to return negative 1,375%? Unfortunately, 98% of Americans today. That's what we're doing. And we've never thought of it that way, but that's 100% what's happening is you are losing your money. Your money is evaporating quickly because it's not even keeping up with the cost of inflation, let alone what you borrow the money, your own money back at the federal funds rate or what the note rate is on your mortgage. So right here, we're kind of looking at what historical interest rates are on mortgages. So for those that refinanced in the last 2 years and you got a 7 or 8%, don't feel too bad because the folks in the 80s got like 18 to 20%. So they're still relatively low. But again, when I talk about the solution later on, HELOC rates are substantially lower. Now, you may have already called. You may have seen some emails leading up to this, like, hey, I'm going to Google some interest rates. You have to know where to look, and I'm going to show you where to look later on. All right, so it's a systemic problem. Why do Americans have so much debt and no savings? So here's a graph: mortgage debt, you got auto debt, student loan debt, credit card debt. And the reason being is specifically is the 30-year mortgage term. See, Americans are buying payments they can afford on a monthly basis instead of total purchase price we can afford for a home. This isn't the case in South Africa, in Europe, in Australia, some places in Brazil. When they look at a home, they're looking at the purchase price. And on top of the purchase price, they have to factor in what the financing looks like on it, right? So let's say we want to buy a $400,000 home. And they say, okay, well, I've got to finance it with a mortgage, which means I'm really going to pay $750,000. Now they look through the lens of it and say, is that home worth $750,000? If the answer is no, they don't buy it. That's not what we do as Americans. Unfortunately, we buy it based on what fits inside of our monthly budget. So what is the payment? Oh, it's $450,000. Payment's $2,200. I make $10,000 a month. Yeah, I can cram that in my budget along with all the other things that I spend money on. Yeah, let's buy that house. So the longer you have the mortgage payment, the less you can afford other items. For example, school, education, cars, vacations, etc. So items that if you can't afford those, guess what else? those get borrowed via credit cards, car loans, and student loans, and exacerbates the situation. So we don't truly own our homes. We just rent them from a different landlord, and it's called the bank at an exorbitant cost. And what we do when rates dip is we chase low rates in refinances or purchases rather than the total interest paid. So tonight, I'm going to give you a paradigm shift to start thinking about total interest paid versus what the interest rate is. Because the interest rate on a mortgage dictates your payment. It does not necessarily dictate how much interest you pay. Two things are far more important than interest rate when financing debt: time and balance. And I'm going to show you some tools tonight where your cash flow can affect time and balance at a much faster pace, massively reducing the amount of interest that you pay. Now, we're also talking about closing costs. So all of these types of debts also come with closing costs that range anywhere from 2 to 5% of the loan, right? So the lower the rate, the higher the closing costs. Talk to any loan officer that's willing to be transparent and say, they're offering you a 6.99 when really 6.75 is available. They'll give it to you, but what comes with the 6.75? A higher rate. So they're going to get their money one way or the other, right? So the higher rate, the lower the closing cost, the lower the rate, the higher the closing cost. I said that backwards. But either way, the bank still wins. So closing costs also increase the principal owed. So who's really in control? This is a graph. Now, this graph is based on interest rates from 3 years ago. Let me repeat that again. This graph is based on interest rates 3 years ago. So if you don't have a sub 4.5% interest rate on your mortgage, this graph is going to be uglier. Now, what this is illustrating is you've got your interest here, because again, a mortgage is an amortization schedule. It's not truly recasting interest like on a home equity line of credit, the simple interest nature and liquidity of a home equity line of credit. So every month, your payment is spoken for how much is going towards principal and how much is going towards interest. And they front load it too. So in the first couple years, as you can see, you're virtually interest-only payments. And everybody here can testify to that. If they're a homeowner and they have a mortgage, they can testify to that. First 5 years, I'm basically making interest-only payments. You don't really start digging into the principal until year 6 and beyond. However, look how many months it takes for your payments to affect more principal than it does interest. That's 222 months. So that's almost 18 and a half years before your amortization schedule and that payment, if you never refinance backwards to get lower rates, it's going to take you 18 and a half years for your payment actually knocking down more principal than what the bank is getting in interest. So again, I go back to this was based off low rates, not the interest rates that we have today. Now, biweekly payments, some loan officers would say, hey, get a biweekly payment. If you do that, it'll knock off some term. It does help to a certain degree, but biweekly payments only reduce your term to 23 or 25 years. What I'm going to do tonight is show you a method that we've helped thousands of people on average pay their home off in 5 to 7 years, not 23 to 25 years. Now, a 15-year mortgage is going to drastically reduce the amount of interest you pay. However, it's also going to drastically increase your monthly payments, which allows little flexibility in your finances if something were to happen. So the bank dictates the allocation of your payments to either principal or interest. So when money goes into a mortgage, I'll say this slowly. When money goes into a mortgage, it goes to interest first, then principal is calculated. However, with a home equity line of credit or a business line of credit or a commercial line of credit or even a credit card, when money goes in, it first and foremost goes to principal, then your interest is calculated on what's called per diem or daily interest. That's what we're going to do. We're going to flip the control back in our favor and use a cash flow strategy. Now, the government's role in mortgages, because the government basically took over the mortgage industry after the last debacle of 2008. There were some pros to that, and there are definitely some cons to that. And don't get me wrong, I'm a big fan of our country, but name one business the government has taken control of and made better. I'll wait. Not never. So government's role in mortgages. So 99.3% of all mortgages are now backed by three major government enterprises. It's Freddie Mac, Fannie Mae, and Ginnie Mae. Doesn't matter if your lender is in New York, California, Florida, or Nebraska. If it's an FHA loan, a VA loan, a USDA loan, a Freddie Mac or Fannie Mae, which is now called conventional loans, it's still being controlled by the federal government. HELOCs, however, have less government oversight. Therefore, they are massively different from one bank to another. The reason being is that HELOC there's not really a secondary market for home equity lines of credit. That is an asset that sits on that bank's balance sheet. So now you have a relationship with that bank, and that bank dictates what their risk tolerances are. So they don't have to answer to the federal government. So unfortunately, there's good and bad news to this. The good news is it's a massive maze of different programs from bank to bank and credit union to credit union. That is also the bad news. It's a maze. We will help you navigate that maze so you understand which banks make the most sense for your situation. Now, mortgage insurance. Mortgage insurance is when you owe more than 80% of the value of your home. It is a complete waste of money. 99% of HELOCs do not have mortgage insurance. I know of actually there might be two HELOC products out there that have mortgage insurance, and they're not actually banks. They're mortgage lenders parading as banks. That's why they charge mortgage insurance. So banks and credit unions, especially community banks and credit unions, do not charge mortgage insurance. Most folks think that mortgage insurance is something that protects them. That is wrong. That is called that's PMI. So there is mortgage protection insurance, though, that does protect you, but that's not what's being charged on an FHA loan, a Fannie, a Freddie, a VA, or a USDA. That is just extra funds that is going to the government to insure your loan. It doesn't do anything to pay down your principal, and it also doesn't protect you in a case of default. Now, let's take a look at an example of a mortgage. I've got a fake bank here, but I just want to show you what you typically look at. This is called a loan estimate. Back in the day, it was called a good faith estimate. HELOCs still operate today on what's called good faith estimates, not loan estimates. So after Dodd-Frank, every mortgage lender had to adopt this new way of disclosing to consumers. This is things that you typically see. Loan amount, 162, interest rate, 3.875. I want you to remember that number, 3.875. Because if I were to ask somebody, what is the rate of interest that you're paying on your mortgage? Everyone would tell me this number right here. But listen closely to what I said. What is the rate of interest on your mortgage? I didn't ask what the interest rate was. I asked what the rate of interest was. That's not what this is. This is dictating this number, your payment. Remember what I said earlier? Time and balance are far more important. I'm going to show you why. So again, very easy stuff to understand. This is what you're borrowing. Here's a very low rate. This is a low payment. You've got your taxes and insurance and assessments on here. Look at the closing costs on such a low mortgage. $162,000 mortgage. However, your closing costs are $8,000, and this person's got to come to the table with $16,000 just to get this loan. This is the second page of the loan estimate. This is breaking down what your closing costs are. You've got origination points, application fees, underwriting fees, appraisal fees, flood determination fees, all this other stuff. Title fees. Now, 2/3 of closing costs on a mortgage are actually from a title company. And I will get the loan officers back when I say this, because loan officers get a bad rap to a certain degree when it's like, man, you charge so much in closing costs. They don't get any of these numbers. This all goes to a title company. This does not go to the mortgage company. So these are massive fees here. Again, not things that accompany a home equity line of credit. For example, you've got your initial escrow payment at closing and these fees. HELOCs do not escrow. And in fact, you don't want to escrow. So jot that down, because that may be a question you ask me later. Michael, why don't you want to escrow? That seems like a convenience and something that saves me money. It is not. It's actually something that costs you money. And it's not that they're earning interest on that. By law, they cannot earn interest on escrowed funds, but it is costing you money when utilizing a home equity line of credit. And I'll show you why here in a little bit. So as you can see, lots of closing costs. Now, here's the important part, though. It's the page 3 of your mortgage. So I hope tonight you guys are going to go back to your disclosures. If you refinanced or purchased in the last 5 years, you've got those locked away somewhere. If you don't, you can call up your title company and say, hey, I closed with you however many years ago. Can I get a copy of my disclosures? This is the page I want you to pay attention to. This is page 3 of the loan estimate. And here's what it's telling you. In 5 years, this is how much is going to go towards interest, and this is how much is going to go towards your principal. This is your APR. So remember, we were thinking at 3.875 when it's really 4.27 because of the closing costs. But here's the scary one, total interest percentage. So before they came out with this, I was calling it rate of interest. Then the government came along and adopted their own term called total interest percentage. It's TIP. So on that 3.875% mortgage, you're really paying almost 70%. And how many of us were actually told that at the closing table? Or is this just one of those pages that said, sign at the bottom, yeah, look through this, okay, flip over. They do it real quickly, right? The first page, they didn't. They're like, see, you're getting that rate, you're getting that low payment. Cool, congratulations. This is the page that they don't really like to talk about a whole lot, and that's why. So again, who wants to sign up not only for a bad investment like banking, putting money in a checking account to earn negative 1,375% negative rate of return, but who also wants to sign up for a loan that's charging you 70% interest? And if you're not raising your hand, it's because you're already doing my strategy. And I can tell you that 99% of Americans are not doing this, and they should. If they were doing this, we wouldn't have had the 2008 debacle that we had. All right, this is what it looks like in the calculation for a home equity line of credit. And I'm just using an example here. And we can use other examples of folks that are watching tonight. We can punch their numbers in and use their example to spit out some real world math here. But this is a simple interest calculation. 350,000 is the balance. I'm even going to be conservative here and give a 7% interest rate, which is a crappy rate for a home equity line of credit right now, believe it or not. Rate change per year, I'm going to put 0%. The reason being, and if we'd rewound 5 years, I would increase this, right? Because we were in an increasing interest rate environment. 2 years ago, we were in an increasing interest rate environment. So I would change this to like a 0.5 point a year to 1.5 points a year. But the Fed has already come out and said that in 2024, they have to cut rates. Some are predicting that in March, they're going to start cutting rates, but they've already projected there's going to be 3 rate cuts in 2024, 4 in 2025, and 3 more in 2026. There are some economists that think that there are going to be 6 rate cuts this year. Don't take my word for it. That's just what an economist said. That's not what I'm saying. I think it's going to fall between 3 and 4 rate cuts this year. But nonetheless, that's why I'm not making a rate change, whether it's going down or it's going up. I just want to be conservative. Payoff goal, doesn't really matter what you put here. We work with businesses too that have business lines of credit, business owners that take on debt and say, hey, I got a line of credit over here. How much do I need to divert from this department over this department to pay a loan off in 2 years? And I would put 24 in there instead of 124. So you have to put a number in here to make the calculator work. This is net monthly income. Again, that's net monthly income, not gross. So this is after tax dollars. This is measuring what's going into your account. We're also going to measure what's coming out of your account. And then you've got monthly expenses. This is everything. This is gas, groceries, eating out, vacation, date nights, you name it. That's what this is, with the exception, though, that it is not your mortgage payment. Because if you're refinancing your mortgage into a home equity line of credit, guess who you no longer have to pay? The mortgage company. The interest of the HELOC is already calculated in here, and I can show you examples of that here in a little bit, but do not put your mortgage payment on there. So in a real world scenario, if we were accounting for all expenses and still had a mortgage, then this person would probably have only $2,000 left over. But again, the mortgage is gone, so they've got $4,000 coming out of the HELOC. And as you can see, this is just over 10 years. This is 10 years and 4 months. This is without changing this person's budget. This is without getting better interest rates, which is what we're about to have. This also means that their income never increases for 10 years and 4 months. This also means that their budget never gets better. Their expenses never go down in the 10 years and 4 months. That's not reality, but I just want to be conservative that instead of taking on a 30-year debt, you could actually not change anything about your lifestyle or your budget, and it's paid off in 10 years and 4 months. Now, let's talk about a traditional mortgage versus a HELOC. So in a traditional mortgage, you can't utilize 100% of your income. See, a HELOC allows money to move in and out freely 24/7. So if I were to dump all of my funds into the HELOC tonight, tomorrow, and even tonight, if I wanted to, 5 minutes later, I could take all that same money back out again. It's liquid. Money moves in and out freely 24/7. And in fact, with the right banks and credit unions, with your HELOC, you're getting a credit card associated with it, which is better than a debit card. You do not want a debit card associated with a home equity line of credit. And in fact, I wouldn't use your debit card a whole lot, because if you've ever been a victim of identity theft or fraud, or somebody confiscated your debit card number, how long does it take the bank to give your money back? A long time, weeks, if not months. However, if it's a credit card, they correct that error in a matter of days. So we have banks that actually associate a credit card with a home equity line of credit as opposed to a debit card. But you get check writing capabilities, online bill pay, ATM withdrawals. So the HELOC now becomes your operating account. It becomes your checking account. That's what you're operating out of, instead of putting it into a bank account to lose negative 1,375%. We're going to put it into the home equity line of credit, and we can do so with confidence because we know we have liquidity. If anything ever comes up, it's right there for us to use for an emergency or an opportunity. So the downside of a traditional mortgage is you can't put 100% of your income to a mortgage. Think about it. If you make $10,000 a month and you put $10,000 in there this month, when it's time to pay the gas, utilities, groceries, insurance, car payments, etc., where's it at? It's in the mortgage. It's stuck in the bank's treasure chest. You have to refinance or sell to get access to it again, which both of them are costly. It's also a contract for a payment that is fixed. That is, believe it or not, a bad thing. You may say, well, I want a fixed payment. In a home equity line of credit world, the more you put in there, guess what happens to your payment? It goes down. Guess what happens to your efficiency? It goes up. So you technically don't want a fixed payment. It's a closed-end mortgage, meaning it's an amortization schedule. Again, money's only going in freely. It's not coming out freely. So there is very little flexibility, only money in. However, with a home equity line of credit, you can utilize 100% of your income. So all of your cash flow, first and foremost, can go into the home equity line of credit, where the dollars going in attack principal first, then interest is calculated later. And then the payment varies based on the daily balance. It's also open in line. So you've got flexibility and liquidity of the money going in and out. So why banks don't want you to know this? Real simple. They lose money. You just saw what the interest looked like on a traditional mortgage. It's close to 70%. Where on this one, you're looking at closer to 20%. Even if the note rate on the HELOC is, let's say, we've got some crazy ones at 1.99 for 12 months or 3.75 for 3 years, you're still going to pay some interest because you're not paying it off at the end of every month, right? So you're still going to pay interest, but you're going to pay in the neighborhood of 18 to 20% versus 70%. That's why banks don't want you to know, is because they lose money. Less interest paid means less profit. So again, the interest rate only dictates what your payment is. However, term or length of the mortgage dictates how much interest you pay. So the faster you pay off your debts, the less interest you will pay. So using the strategy, we're going to show you how to pay your home off in less than 10 years. Thus, the bank loses lots of amounts of profits. That's why they don't want you to know. Here's an illustration, because what I want to do is I want to go over time and balance. So you've got a $250,000 home, 30-year, 15. You see the difference in payments, right? The payment's lower on 30, it's a little higher on 15, but look at the interest paid. Interest paid is 206 here and only 94 here. Total paid 456 versus 344. So obviously this one's more attractive, but not that one. It's a fixed payment. It's not flexible, right? And the only way we can dictate this is we got to make more money to cram this inside of our budget. If I were to choose a mortgage, yes, obviously a 15 makes more sense if you can afford it, but a lot of people can't afford a 15-year mortgage. You know, if you look at the statistics, 93% of Americans do a 30-year mortgage. 7% actually do a 15 because they can't afford it. Now, let's talk about segregation of income, because this is why a traditional mortgage was created. And if I can, let me go back in history. I'm a little bit of a history buff, because when my mentor told me this, that, hey, Michael, you're basically a financial dope dealer dealing out financial crack to middle America. It didn't sit well with me. So I did a deep dive on financial history. Mortgages didn't always look like this. Actually, prior to 1913, a mortgage looked very similar to a home equity line of credit. What do you think happened in 1913 to kind of change the game forever? The Federal Reserve. So the Federal Reserve is finally instituted and cemented into American culture. There was many attempts to have a central bank here in America prior to 1913, but 1913 was finally the cement to get the Federal Reserve instituted in this country. There had already been central banks in other countries, and then we're still a new country, believe it or not, to world history. But they needed desperately to have a central bank in here, and I'm going to explain why it's so important for not for us to have a central bank, but for central banks and how profitable it is. So central banks and the Federal Reserve is a backstop to banking community. And what it does is it gives the banks the ability to execute what's called fractional reserve lending. So for every dollar you put in a checking account, they have 10 to lend out, right? So think about that. Let's make it real simple. You hand me a dollar bill and I snap my fingers and I make it a $10 bill. You give me a $10 bill, I snap my fingers and I make it a Benjamin. That's essentially what banks have the capabilities of doing now that they have a central bank. Is another reason why we have $34 trillion of debt in this country. It's also the reason for inflation and the cost of goods and services ever increasing and the deterioration of our dollar. That's why. But that's a powerful magic trick. Prior to 1913, folks were actually depositing their money into mortgages and it was liquid. They could go down to the bank that day and say, hey, I've got a $200,000 farm. I only owe $100,000 on it. I need 10 grand to buy some farm equipment. I'm going to cultivate my crops. When I make 20 grand, I'm going to put it back in here. And now I only owe 90. I'm like, no problem. Here you go. Yeah, it's worth 200. You owe us 100. Here's 10 grand. Good luck to you. When you get your 20, bring it back in here and it'll be just as liquid. That changed after 1913. Banks got together and said, holy crap, if deposits are this powerful, that every time we get a depositor, and again, let me back up because I didn't mention this too. I sit on the board of a bank, a joint venture with a publicly traded bank up in Michigan. We have these internal talks, and every meeting we have, what's the number one thing discussed is how do we grow core deposits? They want deposits because of this magic trick. So the banks got together and said, how do we get more Americans depositing money into checking and savings accounts? They looked at what people were doing with their money. They were not hiding it, but they were depositing it into their mortgage. So they changed it and made it the modern day mortgage. Mortgage hasn't always looked like it does today. It used to look very differently prior to 1913. It used to be semi-liquid. So they made it a closed-end product. But they said, well, let's give them another benefit. Let's make it a 30-year term so that the payments are cheaper and they'll view that as a benefit. But we'll put this amortization schedule in there so we get 100% profits in years 1 through 5. That way, if they were to sell or refinance, we've already gobbled up our profits and they didn't touch the principal of it. That's what they did. That's what we're consuming today is the modern day mortgage. So they used it as a tool to segregate our income. And this is what it looks like, traditional mortgage. This is what's happening in real world. You get a paycheck, goes into a checking account. From the checking account, it goes to a mortgage. Then you've got your credit cards you paid, and you got your student loans you paid, then you got your other bills. That's what it looks like. And then you may have some extra money. Then it goes into a savings account. Then from there, it gets segregated to your retirement, to your vacations, right? That's real world. This is what it looks like in America today. However, this is what it could look like if you had a home equity line of credit in place of your mortgage. It's a more streamlined approach. Heck, even Dave Ramsey can't argue this. What does he talk about when it comes to debt snowball? Focus on one debt at a time. Focus your cash flow on one debt at a time. That's essentially what we're doing here with a home equity line of credit. We got our paycheck. It goes to the home equity line of credit. From the home equity line of credit, we pay our bills. Everything that's left over continues to reduce the principal balance of the HELOC, and it recasts automatically every single day for free. Make a note of that. I want you to ask me that question later on as well, what recasting is and why it's beneficial to you, but it does it every single day automatically for free to your benefit. So we're streamlining our cash flow to evaporate and attack most efficiently the debt that we have. Closing costs, when it comes to HELOCs, there's very low closing costs in HELOCs, which means less profits. That's another reason why they don't want you to know this. So the U.S. average lender closing cost is $2,525 with 20% down. And then the lenders, bankers, make additional profits on what's called junk fees. You know, junk fees are processing fees, underwriting fees, application fees, origination points, discount points, et cetera. HELOCs typically don't have lender fees. The only fees to expect are title and recording fees. So the HELOC is going to save you $2,500 right off the jump, and that's on average. And we're talking about an average mortgage, where if you're getting an above average home equity line of credit, you're going to save even more. Even loan officers and bankers don't know this. Heck, I didn't. I rose to not quite the top, but I was a senior vice president of a federal bank. I was a pretty high up echelon executive in the banking industry. And I'll be honest with you, I didn't know this until my mentor shared this with me, until I discovered this on my own, going through websites, doing the math. I hired a CPA and an actuary, and one of my best friends, and now my business partner today, Matt Workman, we dug into this. We honestly tried to poke holes in this because we didn't want this to be true. He was managing billion-dollar funds with Wells Fargo, and he's like, yeah, we don't want this to be true. So let's try to figure out a way to poke holes in it. The more we started prodding in this, the more it started proving out that my mentor was right, and we were the dope dealers. So one of the more frustrating things about implementing the strategy is having to first educate the banker or loan officer, because they don't even know. You Google a bank and call up a bank and say, hey, banker, I would like to refinance my mortgage into a first lien position home equity line of credit. I'm going to use it as an operating account, dump all of my cash flow into it. Therefore, I'm going to suppress the principal of that on a daily basis. Therefore, the time, and I'm going to reduce the amount of interest. Oh, by the way, I'm also going to be liquid. That way, if emergencies come up like COVID or an opportunity comes up like real estate investing, then I'm able to capitalize on it. The banker is going to look at you like, what'd you just say? They don't know. And this is something else I'm going to say, and I get a lot of flack for saying this, but I'm just going to speak the truth. Bankers are stupid. Loan officers are smart. The reason why I say bankers are stupid, they're generalists, right? If you're real estate investors, and a lot of you guys are following Noelle because she does a really good job educating you guys how to invest in real estate. If you're a real estate investor, your taxes are a bit more complicated than the average American who just has a 9-to-5 W-2 job, right? So when you're going to get a CPA, you don't want a generalist, you want a strategist. So I have a tax strategist, I don't have a tax preparer, right? A banker is a generalist. You go into a bank, hey, you need a checking account? Cool, I can help you out. Savings account, CD, money market, you need some insurance products, you need a home equity line? Yeah, I can give you that too. They're not well trained and versed on this topic. Loan officers, the reason why I say they're smart is they only get paid a commission if you close and fund. So if there are hurdles, they will look at it and say, what are ways that we can reduce the debt ratio in order to get this person qualified so that they can close? So all these hours I've been spending on this file, I can actually get paid for. Bankers get a salary. They don't get bonuses for closing home equity lines of credit or commissions for closing home equity lines of credit. So it's not in their best interest to even learn. So just like you, most bankers and loan officers have never heard of the strategy, and they just haven't been adequately trained purposely. The typical thought is you can only get a loan for the percentage of the equity that you have between the balance of your traditional mortgage and the home value. After all, it's called home equity line of credit. And that's what trips a lot of people up, is that little E there in HELOC, right? Equity. It doesn't have to be that way. However, HELOC can be a first lien position loan to pay off your existing mortgage and any debts that you may have that you want to pay off very fast with tax benefits. And I usually have to speak to, like I said, when I was doing this for the first time in 2012 on my personal home, it took 3 to 4 individuals at each bank. I talked to 10 bankers in order to get to the right answer. They just don't know what they don't know. And heck, I didn't know, and I was an executive for one. And like I said, HELOCs don't pay well. A HELOC, when I say they don't pay well, let me back up. There are some banks that may pay anywhere from $250 to $750 for a home equity line of credit. That is not good compensation. So most just don't compensate LOs at all for providing a HELOC. A traditional mortgage usually pays 1 to 2% of the loan amount. So let's say it's a $500,000 loan, and let's pick 1% just to be conservative. That's $5,000 versus $250. You see why they just don't incentivize them. And here's the other thing: you got to follow profits. Programs that have the highest profits come from consumers overspending. Programs that have the highest profits typically come from consumers overspending. That's where commissions come from, is from profits. So do you want to consume the products that have the highest commission rates, or do you want to consume the products that have the lower commission rates? That's what the home equity line of credit is. It saves you thousands right there. So think about it. The bank makes less, so therefore they pay less in commission. And then the banks typically sell the traditional mortgages on the secondary market for additional profits, where HELOCs stay on the bank's balance sheet. And thus it's creating less profit for the banks on the secondary market, because there is no secondary market for a home equity line of credit. Think about your mortgage. You signed the closing documents, and before you even made your first payment, you got a letter in the mail that said, oh, by the way, we don't own your mortgage anymore. It's been sold to this person. It's called yield spread premiums. That's where they make even more money, because mortgages are profitable. It's something else that's not a part of this presentation, but it's a part of my personal story that I think you should understand as well. Prior to this joint venture with this bank that I'm a part of and sit on the board of, I sat on the board of another one, actually a small community bank here in Tennessee. And we were doing a lot of HELOCs, because this is what I was teaching. And they're like, yeah, we can provide the HELOCs. It's like, okay, well, I've got a decent sized audience. If we push go, you're going to have a lot of volume. Nah, don't worry about it. Well, within 6 months, they're like, you're getting us too much volume. So they reached out to hedge funds and said, hey, can you buy this paper? And lo and behold, there was a couple of hedge funds that reached out and said, yes, we love first lien position home equity line of credit paper. So we started having meetings and discussions with them. And what we found that I didn't know when I first started doing the strategy that I found out in 2015 is that the reason why hedge funds like first lien position home equity line of credit paper is they learned their lesson in 2008. Secondary market mortgages, guess what happened? They lost their butt when it came to those mortgages. It was rampant foreclosures, especially in second mortgage position. It was very risky. They lost tons of money. But what they found was this little golden nugget in the data that folks with a first lien position home equity line of credit did not default, even if their income went down. So here's the stat that they gave me. First lien position home equity line of credit paper had 115 times lower default rate than those with a first mortgage. The reason being is if you have access on that line and something happens, you know what hits the fan, you have a loss of income. COVID, we had about a dozen clients that this happened to, but they were clients of ours for a couple of years prior to COVID. And they were actually able to mechanize the home equity line of credit as an insurance policy to pay them and provide them supplemental income to get back on their feet. And they didn't even have to make payments to the HELOC. It was actually making payments to them. Again, not something I prepared for this presentation, but what I just shared with you, if you're a senior, I just showed you a way to create your own reverse mortgage for free. And reverse mortgages have the highest commissions in the lending industry because they have the highest profits, because they're extorting our best generation, which is our seniors. And I just shared with you a dirty little secret of how you set up. Oh, the lights in my office just went off. Bear with me, Noelle. I've got a motion sensor on my office. There we go.
Okay, there we go.
Yeah. So I just shared with you how you set up a reverse mortgage without contacting a loan officer, without contacting the Mystic Mustache guy, Tom Selleck with AAIG to give you a reverse mortgage. You can absolutely do it for free on your own. So again, it's just not in the bank's best interest that you know this dirty little secret. So what happens to your money? So what would happen if you put 100% of your income to a traditional mortgage when it's time to pay your bills? You couldn't get your money back. It's in someone else's treasure chest. However, a HELOC allows money to move in and out freely. So when it's time to pay your bills, you just simply use the HELOC to do so. So life is fluid and unexpected events happen, like medical bills, car problems, et cetera. It's okay. It's sitting there in your HELOC and it's liquid with a simple click on your phone. A traditional mortgage locks you into a contract with no access to your equity, which could lead to credit card debt or foreclosure. So what are the qualifications for something like this? I talked about how this wasn't for everybody. You need to be cash flow positive. You need to have more money coming in than what's going out. Number two is you need to have decent credit. Not perfect credit, but you need to have decent credit. And my recommendation is 680 and above. I'll be honest with you, there are lots of credit unions and community banks out there that will lend HELOCs at lower credit scores than that. But I think if you have lower credit scores than 680, then there's an issue there. There's probably a budget problem there, that you've missed some payments or you're over leveraged, got high utilization on some things that should be addressed first. It's not saying you can't do it. You probably can. But my recommendation is don't attempt it until you've got a 680 credit score or higher. And then the third thing is you need to have 10% equity in your existing home. And if you're not a homeowner and you're looking to purchase, 10% down. Because believe it or not, there are some banks, there's not a lot, but there are some banks and credit unions in this country that will allow you to buy a home with a home equity line of credit. Now, I don't mean leverage another property. Let's say you're a first-time home buyer. You can buy a rental property. Primary residence requires 10% down. Rental property is 20% down, but you purchase that home with a debt tool that is a home equity line of credit. So big thing here is cash flow is king. You got to forget about your checking account and savings account. Remember, it only pays you 0% on a yearly basis if they don't charge you any fees, and it's also excluding inflation. So sometimes you have your paychecks directly deposited straight into your HELOC. And the bank that I sit on the board for, that's how we mechanized it. We allow people to deposit their checks directly into the home equity line of credit, not just into a checking account and then they get swept over. So when you use every dollar to pay down your debt all the time, your daily interest charges are reduced. And doing so over the life of the loan has a tremendous compounding effect. Now, the bank is going to give you, again, checks, debit card, really a credit card for your HELOC to use however you see fit, just like a checking and savings account. So for the best results, you need to put every penny into your home equity line of credit. That's tax refunds, that's cash, that's paychecks, everything. I always get this question. It's like, well, what if I sell a car and, I've got 10 grand? What would you normally do? Well, I'd put it in my checking account. That's what you do in this situation. Everything you would normally put in your checking account is exactly what you're going to put in a home equity line of credit. Everything. All right. So again, all income goes into the HELOC. So you're going to roll it in. A HELOC increases cash flow. Let me explain why a HELOC increases cash flow. You don't want to escrow. Remember I mentioned that earlier? You don't want to escrow. So you don't want to give your money to a lender each month to hold on to your escrow money for free. Allow those funds to drive down the balance and interest. So think about what an escrow account is doing in a traditional mortgage setting. Let's say you've got $1,000 in homeowners insurance and $1,000 in property tax. It's easy math, right? That's $2,000. So what they're doing is they're collecting that on a monthly basis of a little less than $200 a month, and they're holding on to it. And then when it comes due, your property taxes come due and your homeowners insurance come due, they send a check to those entities on your behalf. Now, why is it that they want to do that and they want to control that? Because something sits in front of them, even if they're a mortgage holder. That is government, tax liens. So they want to ensure that your property taxes are paid, because if you don't pay your property taxes, it doesn't matter what you owe the mortgage company, the government comes and takes the home and the mortgage company has to deal with it from there. They don't want to. They want to be in control of that and pay the property taxes. Same thing when it comes to homeowners insurance. If you don't pay the homeowners insurance and there's a fire and it burns down, well, guess what? Nothing pays off the mortgage holder. That's why they want to control that. They don't make money on it, but you are actually losing money. In the home equity line of credit, instead of that money sitting somewhere on the sidelines, it's called sleeping money. You want to wake it up and it's deposited in your home equity line of credit. So for instance, here in Tennessee, taxes are due February 28th. Now we get the bill in October, but when do you think I pay my property taxes? February 27th, right? Sometimes February 28th, but right at the last minute, because I would rather it's sitting somewhere doing something for me. It's active money. My dollars create baby dollars, and it's doing something for me versus nothing. Now, I'll be honest with you, this doesn't move the needle a lot. So you're probably going to average about $2,000 a year in savings. Now, you would also roll in car loans into this. I don't care what the interest rate is. Believe it or not, cash flow is king, and you still want to roll in car loans into this if you have availability in the equity in your home and on your line amount that you're approved for. You want to roll it in there. So let's use an example of a $30,000 car loan, even at a really low interest rate. Right now they're at 9, 10, even higher percent interest rates, but let's just say it's closer to 0 or 1.99. You're still going to be at about a $552 a month car note. If you roll it into the home equity line of credit, you've actually increased your cash flow by $453 a month. Think about it this way. Every $10,000 that you borrow on a home equity line of credit is about $32 a month. So if that's a $30,000 car loan, it's actually increased your minimum payment on your HELOC by $96, but you pocket the $453, which means $453 additional gets added to the balance every month of the home equity line of credit out of your cash flow, which decreases the term by another 2 years on average. So that's $5,453 a year. Credit card debt. If you got high interest credit card debt, throw them in there. $30,000, that could be a $300 a month payment. And if you throw it in the HELOC, you freed up another $204 a month of your cash flow. That'll decrease the term 11 months on average, $2,448 a year in savings. Your tax refund. One, you should not get a tax refund ever. A tax refund means you gave a loan to the government to hang on to for 16 months in order for them to give it back to you in the form of a refund 16 months later at 0 interest. We can both play that game. And I don't recommend everyone doing this. I'm a business owner. I've got 7 businesses. And like I said, I've got a tax strategist and I've learned how to manage my money fairly well. I'm not perfect, but I manage it well. I actually play the game where I try to owe as much as possible. And then I send them a check at the latest possible date. But that money was in my accounts, whether it's my HELOC or my insurance policy or real estate, doing something for me, growing. And then I give it to the government when it's time to do so. And I keep the interest, right? So a tax refund, apply your tax refund if you get one each year to the home equity line of credit. So you normally apply your tax refund to your checking account or your savings account. So just continue to treat your HELOC like a checking and savings account. A HELOC is still considered mortgage interest. And per the IRS, the key word is acquisition indebtedness. And I know the last administration, we had a tax reform, and what made a lot of headlines was HELOCs are no longer tax deductible. That is not true. Think about it. You've got a billionaire real estate developer that became president. Do you think that he's wanting to limit his tax deductions? No. So what we found was prior to that law change, HELOCs, you could only deduct $100,000 of interest on a HELOC on your taxes. Now it's as north as $750,000. And the key word is acquisition indebtedness. I even talked to my former CPA about this, and that's when I had a tax preparer, not a tax strategist. And I said, here's the tax law. Can you read it and give me your opinion? I'm like, yeah, HELOCs are no longer tax deductible. I was like, but there's a key word there, acquisition indebtedness. And I was like, so if I use the debt to acquire the home or improve the home, then it doesn't matter that I changed the nature of that debt tool to a HELOC. It's still tax deductible. And in fact, my tax deductions just went up. And she goes, I think you need a new CPA. You're right. And I just don't work with business owners and folks like you. I just try to keep it pretty simple. Like, no problem. Let me go get a tax strategist. So apply your tax refund towards a debt that is tax deductible. That's double dipping and smart investing. So this is going to further accelerate the payoff term as well. So again, we talked about Dave Ramsey and debt snowball. On a HELOC, the payment adjusts every month based on the principal balance. So as the balance goes down each month, the interest or minimum monthly payment decreases, thus gaining more and more momentum each month. So again, as the payment decreases, that much more is going towards your principal each month, thus increasing your cash flow. And this creates a debt reduction snowball. So as you can see here, and this is very simple as I can make it. Month one, 200,000, income goes in at $7,000, expenses come out $4,000. It's actually more beneficial than this, but I just wanted to make it really simple. You see what your payment did? It went from $698 to $688. Now let's fast forward to month two. You go from $688 to $677 because you got another round of income and another round of expenses. So your payment is adjusting each month and it's getting lower. Therefore, if you're still making the same amount of money, you're gaining efficiencies. Now this is only 2 months. So it doesn't seem like a big deal to save, what is that, $21 in essentially 60 days. But if you fast forward 5 years, it has a compounding effect. Now, let's talk about leveraging your equity. You know, because we talked about being defensive. Now let's talk about being offensive with a home equity line of credit. So example, let's say you paid off a $350,000 home in 5 years. Well, you now have $350,000 available in funds to buy another asset. So your home will continue to appreciate in value, with the exception of 2008. But historically, you know, if you look back 20 years, real estate continues to increase. Now, we'll say this too, and I know we're talking to a group of real estate investors because that's what Noelle practices and preaches is real estate investing. If you think real estate is worth a lot now, imagine 18 months from now. If the Fed does cut interest rates 3 or 4 times this year, 4 times next year, all of those people sitting on the sidelines, it was like, you know what, I'm going to wait to buy real estate when the interest rates come back down. They're going to jump in. We already have such short supply. Now you get even more buyers in the market. What do you think that's going to do to real estate? Boom, through the roof. So your home's going to appreciate easily in the next 18 months. Now, I'm using historical averages here, 2 to 4%. But the cash in your home, it's actually stagnant. It's at 0% excluding stagnation or inflation. I had a mentor explain it to me this way. Michael, if I gave you $300,000 and you put it in a tin can and you buried it in your backyard and you can't dig it back up for 30 years, what do you think the value of that tin can is? Most people say $300,000. The answer is $123,000. Here's why. Because of inflation. Because 30 years from now, that $300,000 is only going to buy $123,000 worth of goods and services. So your money's evaporating. So if you have a home, even if it's free and clear, you've got a lot of equity, let's wake that up and let's go buy some cash flow assets that are reoccurring every single month to increase your monthly budget, and not your expenses, but increase your monthly budget to go acquire even more cash flow. That's how people, especially in real estate, go from year zero of knocking on doors and trying to get properties, and you fast forward 5 years, they're multimillionaires. This is one of the ways that they do. So again, 0% is a horrible rate return given the investment markets today. So keep in mind, the money that you borrowed is also tax deductible too. So you're using tax deductible money to go create cash flow assets. And there's other vehicles that can increase your net worth at a low risk as well. So now you can take advantage of investing large amounts of money like the big players do and allow your money to start working while you sleep. So again, you can become a real estate mogul. You can buy an investment property. You know, how can you get 5 properties instead of just one without any of your own money by using bank money to finance at 80%? So you can either buy a rental property without having to go through the mortgage process of getting approved because you've already been approved years ago because you got it sitting right there in your home equity line of credit. You're liquid. So you can just go pay cash on that property with your home equity line of credit. So an example, you buy a $100,000 property with your HELOC. Now, I know there may not be a lot of $100,000 properties out there, but I just want to keep the numbers very simple. So $100,000 property with your HELOC, your payment's going to be $349 a month. But let's say you can rent it for $1,000 a month, right? Noelle will tell you this, that it's a 1% rule. Whatever the purchase price is, should be the bare minimum of what you charge in rent. So it's a $100,000 property, you got $1,000 a month in rent there. So you use bank money that's going to charge you $349 to make $1,000. Isn't that what the banks do with our checking and savings accounts? That's right. It's called margin of turn. We can play the exact same game. So you're using the renter's income combined with the same strategy in your current cash flow to pay the home off even faster because now you've just acquired an additional $651 a month of additional cash. You will then have multiple properties on free and clear and just create another asset with $1,000 per month in additional cash flow. All right. So you could also buy a vacation home. Now you can purchase anywhere in the world using this method. You could buy a vacation home and have both homes paid off an average of 10 to 14 years. And the reason why you can purchase anywhere in the world is because you're essentially paying cash and you're not subject to loan approvals in other countries. So most folks don't get one home paid off in 30 years. Instead of paying rental costs for a vacation, you're now taking the family to the beach villa for free. And you rent it out during the weeks that you're not staying there. Now you can employ a management company to rent it out when you're not there. They're typically 10%, depends on the market. You know, if you're in the panhandle of Florida, it could be as high as 25%. But you can employ a management company to work that property for you, and you're just collecting the money. And just like on a rental property, you're going to use that cash flow to accelerate paying off this property as well. I really love short-term rentals because of the cash flow of it. If you get in the right markets and the right property, you can get it's exceptionally more cash flow on a short-term property than you can on these buy and holds as far as rental properties. And correct me if I'm wrong, Noelle, but I'm not the expert when it comes to real estate investing. I just want to talk about financing. So if I say something that's out of turn, feel free to correct me.
I'm here. You're good.
Yeah. So again, you can buy a vacation home. Now, let's say you pay your home off, right? Your home's paid off in 8 years, but you're still contributing $1,500 a month for the next 22 years. I just want to show you what retirement looks like, right? Let's say you're in your 30s and you're like, all right, hey, this is great. I paid my home off. I honestly don't focus on paying my home off anymore because now that I have capital via my home equity line of credit, my cash flow, my insurance policies, and all of that, opportunities smack me in the face every single week. But I do remember when I was broke and humbled, it didn't matter how many opportunities were out there, I couldn't take advantage of them. So I didn't spot them. When you start executing on the strategy, you're going to start opening your eyes to all other opportunities that can create additional cash flow assets. But let's just say you wanted to pay your home off, but you still have that habit of spending $1,500 a month towards the home equity line of credit. But what if you continue to do that for the next 22 years? This is what your income looks like. And we're talking about an 8% return here. So now you're growing your nest egg by another $722,000 in addition to what you would have done if it was just a traditional mortgage, because now the mortgage is gone and now you're still contributing what you would have put towards your home equity line of credit. And for 22 years, you've actually increased your retirement portfolio by another $722,000. So it's better than just waiting 30 years to pay off your mortgage, right? Last thing I'll share with you, things are liabilities. So I made a commitment when I told my wife, I said, listen, I know I'm a senior vice president and executive for this federal bank, but I'm about to throw it all away because I just don't feel good about what I'm doing. We're not doing it. We started doing this in 2012, but I didn't build the business until 2014. So there was 2 years where I'm still talking to clients and telling them to get mortgages. And it just didn't sit well with me. I was like, I'm sorry, I can't do this. So I'm actually going to build a consulting business and do this, and hopefully God gets my back. Now, you don't negotiate with God, but this is essentially the way it went in my mind. It was like, God, this is what I'm going to do. I've got a wife and kids and a house. If you could bless this business, I promise I'll always glorify you. So that's this portion of the presentation, and last portion. Things are liabilities, people are assets. So in your pursuit of financial freedom, don't forget what matters most. Here are some things to remember along your journey. Give. You cannot give what you do not have. We may give without loving, but we cannot love without giving. That's from Bernard Meltzer. And I'll also go off script here real quick, and I know we're running out of time. I was part of a small community church in my hometown 15 plus years ago. And at the time, was still doing well financially, right? And part of that church, they were having VBS, they were having mission trips, et cetera. Everybody's got that member of their family that they're holier than thou, and they're just a better Christian than you are, right? And, they're talking about how, I'm a good Christian. So, okay, I get it. And this is where it started to make sense to me that money does matter. It's not the end all be all. It's not something that should be idled, but it is important. And we shouldn't be fools with it, right? We talk about the parables of the talents that Jesus, as far as the 3 men, the one that went and buried his master's money in the dirt and didn't do anything with it because he was scared to lose it. He called him a wicked fool, right? However, the ones that multiplied it, he glorified. So we have to give. And when I go back to my church example, when I was there, they had those things. I ended up moving away from that town and attending another church. Well, guess what? Other people in that community church started doing the same thing. So then they stopped doing VBS. They stopped having mission trips. The more you make, the more you can give, the bigger the impact it can have on this world, including your church. When you're tithing, the more you're making, the bigger the tithe, the more impact you can have. My church actually frees people from slavery, like areas like India and whatnot. So every single week we have these testimonials of where we're freeing people from slavery. Believe it or not, there are millions of people in this world today in 2024 that are in slavery. That's what is a big mission of my church right now, is that's what they're doing. And sometimes it's only $2,000 to get a family of 5 out of slavery and into a different location with a job. And now they have their freedom back. So you have to have the ability to give. Share. So just as I've shared this with you to transform your life, share with somebody else and pass along this gift. Love. You cannot love too much, and it's never a bad time to show it. So when you're on your deathbed, and I have been, when I was in my junior year of college, I had heart failure, rushed off to intensive care. I had passed out and flatlined twice, and they had to resuscitate me. And I can promise you, as somebody that's been there, when you're on your deathbed, you're only going to be thinking about the times that you didn't show enough love. You're not thinking about how many points you scored in the game or how much money you've got. It's, does that person know that I love them, and did I show it enough? So be sure to do that. Faith. Life is short compared to eternity. Life is a short test for the ultimate reward. So if you are blessed, give blessings to others, share your faith with others, because if you truly love them, you're going to want to spend eternity with them. All right, so next steps. If this is something that you that speaks to you and resonates to you, and you're ready to change your circumstances today for the better and get in this program, we actually have a discount for Noelle's audience. And I know it sounds like a marketing thing, but we really do. So there's a QR code here. If you want to get your phone out and scan this, you can scan it, or you can go to this link. It's noellerandall.com/RYM, which is short for mortgage. Here's what we're going to do specifically for this audience. This is something that we normally charge $3,497 for, right? And it's a do-it-yourself program. We actually have something that's a done-for-you program, but let's not talk about that tonight. This is a do-it-yourself program where we've got a long library to show you the ins and outs of this. What is step one? What is step two? Also, what banks make the most sense for your situation? That's something else that's going to be a part of this. So it's normally $3,497. However, if you're watching this tonight, if you act within 24 hours, it's going to be $2,997, so $2,997. So we're going to knock $500 off, because I love action takers, and I'm sure Noelle does. People that sit on the fence and sit on the couch don't get anything done. People that take action get what is coming to them and what they deserve, right? So if that's you, take action quickly. You're going to save $500. It's $2,997. You can scan the QR code or go to this link. Now, I've soaked up an hour and 23 minutes of your time, but I also want to allow time to answer any questions that you have. So we can go with that. Here, I'll stop screen sharing so I can see you guys. 2 ways to ask questions. This is your show, Noelle. You can unmute them and they can ask verbally, or we could, throw it in the chat.
Let's put them in the chat. Everybody just put them in the chat, because the great thing about it is we're also live streaming. So obviously we have the audience that's here. That's actually like my people. They signed up. They're here on the Zoom. So they actually get to ask their questions. And then it's live streamed. And so the people that are just watching it on YouTube can see it. So we have the live stream going, but the people that are actually here, they get the benefit of really asking their questions and having a real conversation with both of us. Because like I said, this is great information, and is one of the great things that I always said. I think we have the very similar stories working in the mortgage industry and then building our own businesses up, and knowing that it really is a lot of hidden information that almost no one can teach you. And then having the different access to the banks that can do this, and knowing what their qualifications are, because this really will set you apart and get you a lot of access so that you can, again, invest in real estate, and even the stuff that about the business lines of credit too, that's absolutely amazing. Most people just don't even know that exists, and that's possible for them. So that's incredible. So let's talk about it. Let's go in here. Let's get some questions. And let's read. Okay, so I see one of the questions is about how many HELOCs can you have open? Let's see.
Yeah, so you can have some banks allow you to have a HELOC behind a HELOC. So let's say you have a first lien position, home equity line of credit on a property. Some banks do allow, not a lot, but some banks do allow you to have another HELOC on top of that HELOC. But I think maybe what they're asking is, how many HELOCs can you have? Let's say you're a real estate investor and you've got multiple properties. How many HELOCs can you have? I would say a fair number is 10. And again, this is a maze, because HELOCs is bank-owned assets. They don't have to answer to the federal government. So let me give you an analogy. You need to borrow money. You ask me and you ask your mother. Well, one trusts you more than the other. I'm going to have 2 totally different terms and conditions than your mother, because I don't trust you as well as your mother does. That's the exact same way it is in the HELOC. If we can remember the mortgage world back prior to 2010, it was a wild, wild west, right? That's the way HELOCs are today. So every bank is very, very different from the next. It's not cookie cutter like mortgages are, but an easy answer, conservative number, is 10 per person. However, this is where it gets really cool, is if you have a real estate portfolio, you can wrap those into LLCs. I don't recommend that you have all 10 in one LLC. Maybe you parcel those out where 3 is in 1, 3 is in 1, and 3 is in 1. And then you have a holding company. Then you can say, hey, I've got this holding company that holds all of this assets. Can I get a line of credit based on the whole portfolio? That's a way to get it done too.
Okay, I love it. I love it. And I know you know so many different ways. So, one of the questions, of course, somebody wants to know about a replay. Of course, well, actually, if you again are in here on this Zoom, we will send you the replay and you'll get a copy of that. So that's a simple one. But Ricardo said, what is a good rate on a HELOC as of right now? I got a
Yes.
notification that rates dropped for HELOCs today. Great question.
Yes. So what we also do, we've been investigating banks since 2014. So we have a full staff that what they do 8 hours a day, Monday through Friday, is they investigate banks around the country. There are over 11,000 different banks and credit unions in this country. So we haven't gotten to all of them, believe it or not, because there's just not enough time in the day to get to all of them. But what banks have done since rates have skyrocketed over the last 2 years is banks still need originations coming in the door. They view HELOCs as that tripwire. They get you in the door, and then once they get you in the door, they get the deposits. Remember how I talked about how deposits are vitally important to them? So HELOC, when it comes to banks and credit unions, they have flooded the market with what we call promo rates or introductory offer rates. So as I mentioned earlier, there are some out there for 1.99 for 12 months in some states because you've got banks that can only do certain footprints and some that'll do other footprints, 2.99, 4.99. If you're not talking about those introductory offer rates, then I would say north of 6%. But think about it. Remember when I said that the HELOCs are very cheap in closing costs, if non-existent. So this is what I've been doing for over 3 years now, is I've had 1.99% on my home. Now, it's only 12 months at a time. But since they're free, I just go from 1.99 to another intro offer to another intro offer. And that may be like, oh my gosh, my mind is blown. What do you typically do with credit card offers? You get 0% in the mail. Right, let me take that 0%. It's the same thing when it comes to home equity lines of credit. If there's no closing costs, it's not costing you anything to just refinance to another intro period to keep your rate low. But I will caution this, don't focus so much on interest rate. See, that's where we've been indoctrinated. We think the interest rate is the end all be all. We're not focusing on the total interest paid, right? Your cash flow is going to dictate how much interest you pay. So I'll be honest, in my situation, it doesn't impact my interest savings a whole lot to have a low promo rate because if I wanted to, I just pay my house off every 17 months. So if the rate was 9% or 2%, it would either be 17 months or 17 and a half months. It doesn't save me a ton of money. I gain a little bit of efficiency, and every little bit matters if I compound that. But I want to caution the viewers, don't focus so heavily on interest rates. We need to do the calculation and see if the interest savings makes the most sense.
Right, because there's just so much power in what you can do with the money, especially if you follow the whole process where you have this low interest rate, HELOC, where you're able to touch the principal and then you have access to more cash. That's really like the moment where you can like use that cash to get cash flowing assets and stuff like that. So great question, Ricardo. Okay, so Anita Golston, she has a great question too. She says, I have a single family home with a mortgage and one that has no mortgage. Which house should I do the HELOC on?
So in my opinion, you should do the primary residence, right? You could do both. So if you have a home free and clear, I still recommend getting a home equity line of credit. And here's why. When you open up that equity and you're now liquid, you're going to start spotting opportunities for other cash flow assets. So people that have homes free and clear, I'm like, you desperately need a home equity line of credit, especially in the marketplace today, because you need to get liquid and you need to get liquid now. Okay, there's going to be some massive opportunities. We may stave off a recession. We may not. And I'll be honest, I'm somewhat hopeful from a personal perspective that we go into a recession, because recessions create massive opportunities. You get things for a discount. And if you're liquid, you can capitalize on those. If you're not, then you're a victim. So get liquid now. So me personally, and this isn't mathematical, I'm going to tell you an emotional decision versus a mathematical decision. I focus on my primary residence because you're talking to somebody that went broke in 2008, lost the home, lost the cars and all that. Surprisingly, didn't lose the wife, but couldn't foreclose on that one. So I don't want that to happen again. Now that we've got 5 kids, I take care of the homestead. That's my focus. Mathematically, you should focus on the highest cost of funds first. So if it's a rental property that you have a HELOC on, it's probably going to have inferior terms and conditions than the primary residence. So you focus on that one first, but you don't focus on two at the same time. That's segregation of income. Focus on one at a time. You gain efficiencies that way. You will pay both off faster if you focus on one at a time versus both at the same time.
Love it. I love it. Okay. And so another question, this is about kind of how you guys help. It says, after you pay the fee, does your program walk you through step by step on what to do?
Yes, step by step. Don't get into the program and then immediately start calling banks, because you're not going to know what to say. And we have 31 very specific questions and how to ask those questions to get the right answers. Powerful questions lead to powerful answers. You got to know how to ask them, and you got to know what questions to ask. So you've got to consume this first. Don't try to fast forward to the finish line. You'll make mistakes and you'll end up getting a home equity loan instead of a home equity line, or you got one in a different lien position that doesn't make sense, or you weren't paying attention to the terms and conditions or the freezing nature of it. The program's going to walk you through that to ensure that you're getting the right one. And we're also going to provide, at the end of it, you'll be able to click a button and say, which banks make the most sense for me? And it's going to spit it out. Here you go. Here are some banks to contact, the bankers that we have a relationship with. And I'll be honest, the bank that I sit on the board with, a joint venture, it's on that list, but so are other ones that I have nothing to do with, nor do I get a fee for.
Love it. Love it. Okay. So Al says, I'm already near the tail end of a 30-year mortgage. It's down to 135K-ish, about 7 years left. There is $35,000 of equity in the mortgage, and I'd like to get solar. Is this going to work with me along with getting the $3,000 to get into this? Will this work for me?
Yeah, assuming you're, like I said, there's only 3 qualifications: cash flow positive, 680 plus credit score, right? And then 10% equity in your home, which he has, right?
Yeah.
I would focus on refinancing the existing mortgage, even if you've only got 7 years, right? Making it more efficient. And if your cash flow will drive it down, everyone can go to, let me screen share real quick.
Yeah.
Right here, replaceyouruniversity.com. And up here, you got calculators, and you can play with your numbers here.
Go ahead, screen
Monthly
share.
income. Oh, is it? Oh, I didn't hit share.
There we go.
Yeah,
there we go. Yes, that.
So replaceyouruniversity.com, calculators. This is the calculation. You're putting in what you owe, or it's, in my opinion, you should get what you qualify for, not what you owe. This is just like a credit card, right? If you got a credit card from American Express, you got a $10,000 limit, you spent $2,000. How much interest are you paying? You're paying interest on the $2,000, not the $10,000 limit. Same thing with a home equity line of credit. So if this is a $400,000 home, I would say, hey, go get a $360,000 home equity line of credit if you qualify for it. Your balance is going to be $200,000, but now you've opened up $160,000 of available equity. Should an opportunity or a crisis arise, you are liquid an additional $160,000. But put in your numbers here, and again, I need to emphasize on monthly expenses, do not put your mortgage payment here. It will be gone by the end of the program. Once you refinance to a home equity line of credit, you have now converted your mortgage to a home equity line of credit, and you no longer pay a payment to the mortgage lender. So this is your expenses above and beyond your mortgage, not including your mortgage. Did I answer that question? I went on a rant.
That was amazing. That's the part that I think where your mind can start to open up to, like, okay, how am I going to be doing things differently? You know, I've already been going on this track as a person, and it's been working this way for me. And it's like, okay, taking an entire paradigm shift and really starting to do what wealthy people do for the position that I'm in right now. That's what it's about. As you start to make these moves towards it, it really does open up. And to your point about opportunity, I cannot stress enough what sucks when there's an opportunity and you don't have any money versus when you go ahead, and that's the best thing to do, is borrow money when you don't need it and get that line of credit and have it there. And then it's like, okay, an opportunity comes and you can kind of, take advantage of it and be more thoughtful about it instead of just like, oh man, missed opportunity and regrets.
Yeah. So, but I want to correct something you said. You're not actually paying for that debt if you haven't used it. So the people that have a free and clear property, get a HELOC on it. If you don't need it, you don't spot an opportunity, which you should. But if you don't spot an opportunity, the balance on the HELOC is zero. Guess how much you pay to them? Zero. It doesn't cost you any money to be liquid. As long as you don't use it, you won't pay interest on it. But I'd rather have access to it, not need it, than need it, not have access to it.
Exactly. 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 Okay. So, all right, we'll take a couple of more. Jessica says kind of the same thing. I have a 30-year fixed mortgage, took out an equity loan at 30-year fixed. Can I still get a HELOC from the same property to pay it down faster?
Yes.
Okay. Yeah, that was kind of a simple one. The iPad says, even though I'm not a homer, this forum was informative, puts me at an advantage. Good job. Thank you. I love that. And then someone else said, thank you to both of us. Mercedes, the program is $2,500. That's the sale price, basically. So it's not
$29.97.
Yeah, $29.97.
Yeah,
Right.
it's normally $34.97, but for your audience, it's $29.97 for 24 hours. After 24 hours, it goes back up to $34.97.
Got it. Love it. Great price. I modified my home because of a hardship. The rate increased 7.2 to 40 years. The mortgage assistant paid $24,000 to my loan and paid me up till June. What are my chances to convert to a HELOC? They did a modification, and so and it's essentially on a 40-year term.
Modifications are fine, right? Even if you had a modification in the past, but you're on time, they're reporting you on time, you had a modification, that's fine. But again, I go back to the 3 qualifications. Do you make more money than you spend? Do you have, I love the thumbs thing, I don't know how to turn it off. Do you have 680 plus credit score, right? And then what was the last one? 10% equity. So if you have the 10% equity and you cash flow positive and 680 credit score, you can work with this.
Okay. I love it. Okay. All right. So I'm going to do, someone said this was very helpful. This is Mr. Lush, your contact information. Okay. So just one more time, did you want to give pull the website up? And then I think there too, if there's any questions for you about this specifically, they'll be able to reach out. But again, this was so informative. I really think if you are even kind of on the fence, you would know that this is something that you should be doing, especially if you have a mortgage already and you're already paying a mortgage. Why not access that equity and lower the payments and do so many other things? Okay.
Yep. So you can either go to this link or with your phone, you just scan that QR code, which will take you to that link. So either way, if you want to type that in or if you just want to scan the QR code, it'll take you to the link so we can help you out.
Awesome. All right. It is getting late here on the East Coast. We have the information right here. Just want to make sure that everybody knows this. This is so much great information. Michael, like I said, I know your time is so valuable. Thank you so much for doing this, for teaching this class. It was just a wealth of knowledge. This is an amazing offer. I think so many people are going to be helped. I have done it. I know so many people. Like this is, I wish I would have known this, like you said, as soon as the crash happened in 2009. And I wish I would have known about this because we both were in the mortgage business, schlepping mortgages when there's a much better way for all of us to own homes. Access equity, not be just paying a bunch of interest. So thank you so much, Michael. Thank you for everybody for attending this class. Like as always, I just want to make sure that everyone has all of the information, all of the resources, and all of the knowledge that you need to be successful. This is Noelle, to your